Okay, our next speaker, Alex Barthalis, is a very interesting individual. He's regarded as one of the top retirement plan administration and consulting firms in the country. His clientele include large corporations, celebrities, high net worth individuals, and he's expanded into professional athletes, and we're a client. We're not any of the other categories, so we're just kind of little business, but we've changed our 401k completely as of last year and our retirement plans based upon what we heard at our discussion last year. His practice is rapidly growing by providing advanced tax, retirement, and wealth transfer strategies to valued clients of business managers, financial representatives, insurance agents, attorneys, CPAs, and a lot of physicians. He's achieved designations of certified pension consultant, qualified pension administrator, and qualified 401k administrator from the American Society of Pension Professionals and Actuaries. He's previously held positions on ASPPA's 401k Summit Committee and Government Affairs Committee. So here's Alex. He definitely knows what he's talking about.
Thank you very much. I was asked to give a speech on sort of business planning, on ways to enhance your retirement. Every business owner spends all day, every day, building their practice. But you have to allocate an equal amount of time to building the financials that run your practice and knowing how your business works and where it's profitable and putting time into saving for retirement and your succession planning and wealth transfer and your insurance needs and your estate tax issues and all of that. Just as much time so that your practice runs efficiently and you get to where you want to go. Today I'll chat about, first of all, my company a little bit. I run a retirement administration firm and consulting firm in Beverly Hills, and what we do is we really specialize in ways to help small business owners, I'll use that term loosely, not pay as much in taxes, save, transfer wealth to their family, split their businesses up, combine their business, a lot of mergers and acquisitions kind of deals. And then on the celebrity entertainer side, protect their wealth and ensure that their spending habits and their corporate structures are proper for what they're trying to do for their various businesses. We'll go over a little bit about retirement plans today, what individual ones, and then some corporate structures, some business planning tips, and then how to utilize for this half hour insurance for retirement, for business and succession planning, and for wealth preservation. So IRAs, who has an IRA here? Probably most of you have an IRA at some point, you've started one. IRAs are wonderful. You put in $5,500, if you're over age 60, you put in $6,500. Each year, money grows, compounds, grows tax-free, and when you take it out at retirement, you're taxed on the distributions. But something that some don't know is that IRAs are subject to creditors. So you're sued. You have a bankruptcy issue. They can attack your IRA. They cannot do that for qualified plans, for 401ks, for profit sharings, for pension plans. And it is actually state specific, but most states it's subject to creditors. Who has a SEP? Anybody have a SEP in here? One, thank you. Even if you don't have one, I appreciate the hand. They are for a company. They do not fall under the legal requirements of 409 Cap A, which is ERISA's governing body of the code. They're very easy to start up. They're very cheap to maintain. There's almost no administrative cost. But what you can't do inside of a SEP, it's very rigid. You can't do exotic investments, things like real estate. Did you know you can invest real estate in your 401k profit sharing? You could buy insurance. You could buy gold bullion if you'd like. You could buy artwork. You could do things like that inside of a qualified plan that you can't do inside of a SEP or a simple. Okay, so as much as it's easy to administer, as much as it's easy to have, it's simple, the structure is very easy. Sometimes, depending on what you like out of your retirement plan, go for some of the more complicated things that we'll show you in a minute. So here's the corporate structures, 401k. Who has a 401k for their practice? Traditional 401k profit sharing plan? Very good. Obviously, all your employees can defer pre-tax dollars from their pay. That's the benefit to them as your employees. They get to put in pre-tax money. And then you get to also put in pre-tax money as an employee yourself, depending on what your structure is. Then the next step on top of that, sort of the not plain vanilla, but the next step on a 401k would be a profit sharing plan. This allows you as the employer to get a deduction for additional dollars that you put in above and beyond the $18,000 that an employee can defer. And you can put all the way up to $53,000 in with that as the employer. If you're over age 50, you're allowed an additional $6,000. Okay? Now, whoever has a profit-sharing plan in this room, you should always focus on the vesting schedule associated with it. Those dollars that you give your employees should and can be subject to a vesting schedule up to a maximum of 6 years. What that means is an employee has to be with you 6 years to accrue all of the dollars you're putting in for them. Let's say they're not. Let's say they're there for 4 years. What happens is the money that you've put in into their account as a profit-sharing dollar, the retirement plan will get back 40% of that. And then therefore, you can use that to reduce next year's contribution. So if you have turnover, if you're looking to hire, if you don't know, what I advise clients on is it's not always about what you give away in a retirement plan to your employees, it's about what they keep when they leave. So even if you give them $1 today, if they don't keep the whole dollar 2, 3, 4 years from now, then it's okay to give it. Next structure, does anybody have a defined benefit plan or a pension plan in here? Old people. Pension. Defined benefit pension plan, yeah. Perfect, on top of the 401k profit sharing, good. Yeah, defined benefit plans are primarily, so in the 401k profit sharing world, right, you're capped at what you can put in each year. In the defined benefit world, it's flipped on its head. You are capped at what you can take out of the plan at age 62 or 65 or whatever the defined retirement age is in the plan. So what that means is that if I can only take out $210,000 a year for life when I retire no matter what, the older I am, the closer I am to 62 or 65, the more money I have to put into the plan at those ages to get to being able to fund the plan to give me $210,000 a year for the rest of my life. So when you're 50 years old, you can put in $150,000 in a defined benefit plan. When you're 60, you can put in $200,000 in a defined benefit plan. You get over 60, you can put $400,000 into a defined benefit plan. It's unbelievable. Very, very powerful. But the contributions are required. So very different than the 401k profit sharing world where you have complete discretion each year on what you're going to contribute. Yay, I'm going to put it in. Nay, I'm not going to. I'd rather use it for business expenses or something else. But in the pension world, the defined benefit world, once you decide you're going to put it in, we'd like you to put it in every year. And then a cash balance plan. A cash balance plan is actually sort of the newest form of defined benefit plan. It came out 7.5 years ago. It is a way of taking the mathematics. I'll try not to be very nerdy. I mean, this is going to put everybody to sleep. But it's a way of taking the mathematics of the pension world, combining them with the mathematics of the profit-sharing world, and testing the two plans together. So what happens is, let's say you were giving all of your employees 5% of pay in the profit-sharing plan. We could use that 5% when we calculate what you have to give them in the pension plan. So we reduce the contribution overall. So if you can afford it, a cash balance plan is sort of a hybrid between the defined benefit plan and the profit-sharing plan. And most people have a profit-sharing plan and then layer on top of it a cash balance plan. Another note, because I don't believe the IRS is in the room, right? No, nobody, good. If you have a small practice and you're a solo practitioner, I advise you to have your spouse on the plan. I advise you to have your children on the plan. Your son, your daughter, their spouses. The family attribution rules inside of retirement plans are pretty great. You're sitting here, you're earning dollars every day that are taxed by the government. You'd rather pay your spouse $20,000 and put away all the $20,000 pre-tax, and all you lose is your payroll tax on that individual. So if you have a plan and you're the only employee and you have a family, start bringing them into the plan as legally and as quickly as possible. Any questions so far? Some tips. Partnership agreements. And this is just an oddity we found. Of all the partnership agreements that are out there, we found that probably more than half of them are actually not valid because the spouses don't sign. And if your spouse doesn't sign, it is not valid. Simple. We can argue completely against it, and we've won. So if you have a partnership agreement, please make sure they're up to date. Please make sure all the partners' spouses sign on the dotted line where they should. Some succession planning or business planning things. I'm going to discuss this in a minute. Buy-sell agreements, key man, golden handcuffs. I know they're sort of large corporate terms, but you can bring them down into a smaller business as well, and they work really well. Just sort of, it's a little creative way of thinking about them. I'll go into that in a minute. And this is another one. You know, you run a business for 20, 30 years, and you'd be surprised that by changing from an LLC to an LLP to an S Corp to a C Corp to a sole proprietor, whatever it may be, depending on what you're doing, earnings-wise, employee-wise, taxation-wise, investment-wise, it's good to look at that structure on a fairly regular basis, especially if you experience large growth or downsizing or there's changes in your practice. You know, instead of just filing your taxes and moving on each year, put some time into maybe having a estate planner look at your structure or an accountant who specifically does this. It's very important. You'd be surprised that you find that by switching structures, you can save tens of thousands of dollars in taxes, or put away more money for yourself, or change your earnings structure. It's really unbelievable, but it's just no one looks at it. They just kind of let it ride. Okay, let's go into how to utilize insurance. Who has insurance, by the way? Life insurance, term insurance, everybody. I know, the worst check you have to write every year. So here's some ways of looking at it in a sort of different light. Very creative ways of using insurance. First of all, is an IRA replacement. You put in $5,500, $6,500 into an IRA. Why? You get a deduction now. It grows tax-free, and when you take it out, it's taxed. You can do the same thing inside of an insurance policy. You can get a deduction now. How? I'll explain that in a minute. It does grow tax-free your earnings inside of life insurance. And then when you take it out, it's actually tax-free. And there are no limits. You can put it whenever you want. Roth. Who has a Roth account? Roth is, anybody know the difference? Who knows what a Roth account is? Yeah, there are income restrictions on how to have a Roth. Roth accounts are, very specifically, you put in after-tax money today, it grows tax-free, and when you take it out, it's tax-free. Okay? So it's I'm going to pay my taxes now, I'm going to take it out tax-free. But they have limits, same limits as an IRA. You could use policies termed as indexed universal life insurance policies that work exactly like Roth accounts. Exactly like Roth accounts. If actually, probably better, because they have investment floors, investment ceilings, your money kind of just grows steadily. You have a tax-free death benefit. You can take loans out of your insurance policy, which you can't do inside of your Roth accounts. You can take pre-59.5 distributions outside of your insurance policy. You can't do that inside of a Roth account. And again, I said before that Roth is I pay my taxes now, grows tax-free, I take it out, it's tax-free. There's actually a way to deduct these contributions as well, which I'll get into in a minute. I'm really whetting your appetite, I know. Salivating over the answer. Oh my God. Insurance. Okay. Did you know you could own insurance inside of your 401k profit sharing plan? Individually owned insurance on your life or any other participant's life. So what does that mean? Everybody pays insurance today. You all pay out of pocket. You pay after-tax dollars. So your $1,000 insurance bill comes, your $1,000 life insurance bill comes in. You have to earn $2,000 to pay the $1,000. You have a bucket of money sitting inside your qualified plan that's been growing there tax-free. It is very legal to use those dollars and buy individually owned insurance inside of the plan. Just many people don't even know it exists. It's the only way to deduct your insurance premiums on the planet. By the way, the death benefit is still income tax-free, as long as you don't have a net worth of you and your spouse of over $12 million. But if you do, that's a problem we can still figure out at the time, and it's usually a good conversation to have. So, and it's, by the way, it is individually owned. It's not corporate-owned life insurance. It's not Coley-Boley products, if you've heard those before. No, this is just, you have a Jackson National policy, you have a Nationwide policy, a John Hancock policy. You can literally buy a new policy inside of your retirement plan, use that bucket of money for something else that you're currently paying for today out of pocket. You can also do something as, depending on the size of your firm, we use this a lot for, might not apply, but we use this a lot for lawyers, actually, in CPA firms where there are multiple partners, handfuls of employees. But what happens is people are uninsurable. So what we do is we buy guaranteed issue insurance inside of the retirement plan, therefore being able to insure everybody in the company. So if you currently have a health issue and you're unable to be insured and you have 5 people that we can put onto your books and have inside the qualified plan, we can actually insure everybody, no matter what. Business succession. And this is a tough one. I mean, everybody thinks their child's going to inherit the business. No child ever does what their parents are going to do. It's the worst succession plan I've ever seen in my life. I mean, it really just never works that way, unfortunately. But buy-sell, we've done some very creative things with buy-sell before. We had an instance, and this is just something to think about. You know, if you pass away and your practice goes under, your spouse doesn't want to take it over, who's going to buy your practice? Who's going to take it over? We've actually found that we can do the buy-sell with your competitors. And that actually makes sense. The people that you compete with, or the people that are in your region that are also doctors and have entities. They're the simplest answer. Who's going to go take your clients? So we've done competitor buy-sells, where we have one business and we go to their direct competitor and we have them buy insurance on each other. Because that's the most logical way of who's going to go after your client. So might as well have your family be paid on that. You can also do buy-sell. We do this all the time within the qualified plan. Again, this way you don't have to pay for it. Your company can take a deduction for the buy-sell agreement. Key man insurance. You hear this with. This is obviously a very large corporation term, but really all it is to figure out a way to entice an employee to stay with you. And there are very, very creative ways of doing this. I mean, there are firms that just do key man policies and insurance and legal agreements and whatnot. But in this specific scenario, you can do things like, you know, pay an employee an extra dollar amount. Then that dollar amount can be deferred based on how long they work for you. Then they can receive tax-free income at a later date. If they pass away, you receive the dollars back that you put in for them. You can structure things like that, extremely creative. In your practices, it might be a way of bringing on a young doctor into your world and looking at a compensation structure sort of like a key man policy. But again, a way for them to be able to grow with you instead of having to pay them the fortune that they probably think they want or deserve. Wealth preservation. Estate taxes, hopefully they're an issue for you. If they are, wonderful. You can use, the simplest way of paying for estate taxes is having insurance on cents on the dollar paid for them. It works very, very well. And then there's actually another creative thing. I don't know if anybody's ever heard of this, pension rescue or pension maximization. Anybody ever heard of it? Wealth preservation. So business owners accrue these qualified dollars throughout their careers, build up a huge bucket of pre-tax money, and then typically don't need it because they've been earning high dollar amounts, they have real estate, they have their home, they have various properties, they might own the building they're now in. So you have this pre-tax bucket of money that's been growing your whole life, your whole work career, and then when you take it out, it's taxed, so it's only worth half as much anyway. So what to do with it? There's actually a way of getting the dollars out tax-free. I won't go into the crazy structure, but what you do is you use the dollars that are inside the qualified plan. You purchase a huge insurance policy, which has a very little cash value in the early years, okay? Because it has a very small cash value, The policy's now worth this much. So when we do your audit for the plan, you can buy the policy out of the plan with after-tax dollars, therefore transferring the value outside, taking the policy, transferring it outside of the plan. Your plan is now left with this little amount of money, and you now have a tax-free death benefit for your family. Okay? It's an amazing thing. If that's a scenario that you foresee, definitely look into some of those creative things. It's exceptional planning tools. Done. How quick was that?